We always, take a very close look at the measure of CEO confidence. The last couple of quarters, in the third quarter and fourth quarter of 22, we've seen the lowest levels since the '08 credit crisis. And so what does that mean? I think the view of where they expect their businesses to be in 6 months' time is uncertain, and as a result, you're not seeing transaction volume. If we look at the volume that we're going to end up the year, it still will be a relatively strong year if you compare it to the 5 years pre-COVID, so 2015 to 2019. But I think that what we're going to see is that there will be pent-up demand built up because there's a lot of transactions that are preparing to come to market, assets that are being prepared for sale that we're just waiting for a window to open.
Well, I think the leveraged finance markets, when they stabilize and come back, there will be a big snapback among sponsors because they probably haven't been investing as much as they would like, just given all the money that's been raised. We talk about dry powder all the time. But in this environment, it's been harder to put money to work.
Yeah.
So that will, if financial conditions ease up a little bit, the leveraged finance markets normalize and stabilize over the next few months, we could see a big upsurge in that part of the market.
The financing is going to be an important aspect, right? So can you get, how much can you borrow, and can you raise capital in the public markets if that's something that you need to do? And I think it positions well-capitalized corporates in a strong position to be able to pursue and execute on M&A if they have the will to do it. And I think that that's going to be industry dependent over the next number of months.
Traditionally, an important part of our role with our clients is making sure that there is a tight rationale and story to communicate to the market about the transaction that you're doing. I think in less volatile times, there's more leeway in terms of what that story looks like. I just think with volatility, making sure that the communication, the elevator pitch, whatever you want to call it, the outreach to investors immediately, or even in some cases before a transaction happens, having all the constituents on board, communication to employees, those elements of what we do are that much more critical in a volatile environment.
I think your point around having a tight story and a strategic rationale for doing M&A is important, and part of it is there's activists who are going to hold companies' feet to the fire, and that's part of the role they play, and we're seeing activists get more and more involved in situations, and M&A is a key one where either they're encouraging companies to pursue M&A for value creation, or they're trying to disrupt M&A that they don't believe makes sense.
I think another driver is going to be that going into 23, as we've seen in 22, certainly the concerns around larger transactions, regulatory scrutiny. I mean, there's a lot of jurisdictions that you have to appease, and I think that's going to be a limiter potentially on larger deals.
I think the U.S. administration has been very clear that they want to be much tougher on regulating transactions generally. They want to look at it through a wider lens, not just on strict antitrust law, but on related issues such as environmental issues, such as labor issues.
If I look at this situation in Canada, where there's some real themes that I think apply globally, we're certainly seeing Competition Bureau be more active, take a harder line on some of the transactions that are happening. And also from a government perspective, we're seeing pressure on certain aspects that they're trying to protect. And so one that's recently come out is around protection of critical minerals, where the government's essentially saying, if you're a foreign state-owned enterprise, you can't buy critical mineral companies. And subsequent to that, we saw them force the divestiture of some lithium-based companies because of the importance of battery materials. So, I think that's going to be an increasing theme.
And there is a positive aspect to this too, which is if knowing that you're in a tougher financing environment, and if knowing that you're in a tougher competition review environment, if knowing it's going to take longer to get a deal closed, and you still want to proceed with the deal, that usually means the deal makes sense. And so all these little tests that people have to go through, gut checks that you don't really have to do in the frenzied environment of the peak of, 18 months ago or other cycles that we've seen. it does mean that often the very best deals get done in an environment like this.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.